Welcome to The Deep Dive from Talk Tickers. If you're prepping for a meeting, need to get up to speed on an industry, or, you're just curious about what moves markets, well, you're in the right place. Today, we're digging into the Q2 2025 earnings call for Mistras Group. That's ticker MG.
Right, MG. They're a key player in asset integrity and industrial services. Basically, think of them as the, high-tech inspectors and medics for really big industrial stuff, pipelines, refineries, even aerospace parts. Their whole job is stopping things from failing catastrophically. So pretty critical services, no matter what the economy's doing.
And this quarter's call, wow, it's a perfect example of the market seeing things differently. I mean, the headlines look mixed, right? They missed on earnings.
They did.
But the stock just took off, jumped over 10% pre-market. So we're here to unpack what management said that got investors so bullish they just kind of shrugged off the GAAP numbers.
Yeah, it's a classic case of, ignore the miss, buy the underlying changes, let's hit the numbers first.
Right.
The miss wasn't tiny. Non-GAAP EPS, it landed at down to 19 cents. Consensus was looking for $1.24. So that's, a 20.8% shortfall?
Ouch.
And revenue, $185.4 million.
Yep.
Pretty much flat year over year, and just a hair under the $185.7 million Wall Street expected.
Hold on. So missed earnings, tiny miss on revenue, and the stock rallied hard. That sounds like maybe hype, unless something really good was happening with profits underneath all that.
That's exactly it. The good news wasn't just buried. It was like the main theme of the call. MG reported a record-adjusted EBITDA for Q2, $24.1 million.
Okay, record EBITDA, that's good. How much up was that?
8.9% year over year. But the real star, the metric the market loved, was gross margin. It expanded massively, climbed 200 basis points to hit 29.1%.
200 basis points? Okay, that's not just tweaking things. That's like putting in a whole new engine. 2 full percentage points on flat revenue. That tells you something structural is changing, right? Like the new management's plan is actually working.
Exactly. That's the difference. It's not just luck. It's structural improvement.
Let's unpack that margin jump. Management pointed right at operational efficiencies, disciplined cost management, and this is key, a better business mix. They're shifting towards higher margin services.
Meaning they're actively cutting out the low margin stuff.
Pretty much. They're intentionally getting rid of the parts of the business that were dragging things down.
And they gave specifics on that, didn't they? They talked about closing some offices, labs, basically walking away from unprofitable work.
They did. And this is really important context for that flat revenue number. They said those closures specifically were about a $3 million drag on Q2 revenue.
Ah, okay. So if you back that out.
Right. If you adjust for that pruning, their core business, the stuff they're keeping, it was actually growing, not just flat. And they say this isn't a one-off. They called it an evergreen effort, always looking for profitable growth, margin first. That definitely makes the flat revenue easier to swallow. But okay, if they cleaned house this quarter, where does the margin growth come from next quarter or next year? Is this sustainable? Or was it just a one-time fix?
That's the key question, isn't it? Management hints it's sustainable through that continued mix shift, but yet Q2 got a big boost from the cleanup for sure. But what really shows they're serious about this profitable alignment, I thought, was this interesting accounting change they made. They reclassified some overhead and personnel costs, about $4.8 million for the quarter.
Right, the SG&A thing. They moved cost from SG&A into cost of revenue. For listeners maybe not staring at P&Ls all day, why is that significant? Moving $4.8 million around.
It's about transparency. SG&A, that's selling, general admin, cost, usually indirect stuff. By moving certain overhead, like personnel directly tied to delivering the service, into cost of revenue, well, they're showing you the true full cost of actually generating that service revenue.
So it gives a clearer picture of service profitability.
Exactly. They made it clear it had zero impact on operating income or adjusted EBITDA. It's just about aligning the costs better, making the core service profitability much clearer for investors.
Okay, got it. Structural reforms making sense. Let's shift to growth then. If overall revenue was flat, some parts must have been doing really well to offset the softness in their big oil and gas market. What's actually driving growth?
Yeah, the diversification strategy seems to be paying off. You look at the segments needing high reliability. Aerospace and defense, that grew 7.4%.
Solid.
Industrials, that market grew 7.2%. And internationally, especially Europe, they saw organic growth over 14%. So these higher margin, maybe less cyclical areas, they're becoming the growth engine.
But the real game changer, the thing that makes them sound more like a tech company than just an old school industrial service firm, is their digital platform, right? PCMS.
Yeah. Yes, PCMS. That's where the story gets really interesting. It's their proprietary software platform for managing asset integrity. Think of it as a high-margin SaaS business.
And how's that doing?
Revenue grew 30% year over year. 30%. It's the brain for all the inspection data, the analytics, managing the workflow.
That kind of recurring data-driven revenue, that's huge for a company like this. How are they pushing that 30% growth even faster?
Making it easier to use out in the field. They just launched a mobile version so inspectors can input data, analyze it, share results like instantly. It speeds everything up. And here's a key stat. PCMS now serves half of all U.S. oil refineries. That gives them this really valuable, sticky, countercyclical revenue stream, helps balance out the ups and downs of the traditional inspection work.
And they're pointing this data power at new high-growth areas, too. That power generation and transmission focus really stood out.
Yeah, that's where they're plugging into modern needs. Think about all the infrastructure for data centers, for AI. They're targeting that build-out. Their power gen and transmission segments saw revenue jump over 30% in the quarter. They're specifically aiming their high-margin integrity services at those really complex, critical assets, basically taking what they do best and aiming it right at the hottest growth spot in the economy.
Okay, let's tackle the elephant, oil and gas. Still their biggest market, right? And it was soft in the first half because projects got pushed back. How did management handle that obvious risk?
Yeah, O&G was definitely soft.
Yeah.
Client deferrals, market volatility, you know the drill. But, and this is a forward-looking bit that got investors excited, management expects a really strong fall turnaround season.
Turnaround season being the period when refineries and plants shut down for major maintenance.
Exactly. And they said the majority of that big high-value work is already awarded. It's in their backlog. That takes a lot of the risk out of the second half for that cyclical part of their business.
That backlog visibility is critical. Okay, let's move to our final deep dive section. Guidance, risks, and the balance sheet. If the fall looks strong, why didn't they give full-year revenue guidance? Seems a bit odd.
They give a few reasons. Ongoing volatility, sure, but also that portfolio review is still happening, meaning more pruning might come, and some uncertainty around new tariffs. They basically said, look, we can't pin down the exact top line until we're done reshaping the business, but they were very firm on the bottom line.
Which was?
The goal is clear. Exceed the FY 2024 adjusted EBITDA level. That baseline was $82.5 million. So it's all about hitting profitability targets, not just sales numbers right now.
Okay, now the tricky part, the balance sheet. Negative operating cash flow, $3.5 million for the first half. That usually spooks investors. What happened there?
Yeah, it definitely catches your eye. This looks like the growing pains of the transformation, that negative cash flow. It was tied to delays in invoicing and a buildup in unbilled receivables. And they blamed it directly on switching over to a new cloud-based ERP system, Enterprise Resource Planning. That went live April 1st.
Okay, but explain that. Why does a new internal system mess up getting invoices out the door?
Well, think about it like changing the entire plumbing of your house while the water's still running. The new system connects everything contracts, service delivery, billing. When you flip the switch on something that big, you always hit snags. Maybe data didn't migrate perfectly, maybe people aren't fully trained, maybe the system just takes time to link a completed job to the right billing schedule. So the work gets done, but the invoice gets stuck in the system for a bit.
So management is saying it's a temporary clog in the pipes, basically, a timing issue from the tech switch, not customers refusing to pay.
That's precisely their message. They sounded quite confident that the ERP system is getting sorted out. They expect much, much better free cash flow in the second half as they work through that backlog of delayed bills.
Makes sense. What about debt? With this focus on profit, what are the leverage goals?
They're keeping a close eye on it. Right now, their bank-defined leverage ratio, that's debt to EBITDA, is just under 2.75 times. Their banks allow up to 3.75x, so they have room. But their own goal is tougher. They want to end 2025 with leverage below 2.5 times. That shows debt reduction is a top priority, using that cash flow they expect in the second half. Hitting 2.5x would be a really strong signal of financial health.
So if we put this all together, the narrative is they took some pain this quarter, the EPS miss, the cash flow hiccup, but it was all in service of building a more structurally sound, higher margin business for the long run. What's the big strategic picture?
I think the big shift is really happening now. They're moving away from just being a contractor you call for an inspection. They want to be a strategic partner, using tech, providing integrated solutions, more value, more profitable, getting closer to customers was the phrase they used. And they backed it up, mentioning like over 100 exec meetings just this quarter, trying to drive that deeper relationship and cross-selling.
Okay. That brings us to our This Is Not Financial Advice segment. Time to put on our boldest analyst hats, synthesize all this, and pitch a high conviction, maybe slightly outrageous trade idea based on the call.
All right. We're calling this one the margin momentum call. The core idea is simple. We think the market hasn't fully bought into how sustainable that 200 basis point margin gain is, or how committed management is to keeping costs tight structurally. There's a gap, we think, between MG's current valuation and where it could trade if it executes, especially compared to more tech-focused industrial peers. We're betting that gap narrows.
Okay, the structural story is there, but there's that short-term cash flow risk we talked about. How does the trade balance the opportunity against that execution risk? What are the specifics?
Okay, so the idea is you go long MG stock, betting on this turnaround and margin story playing out, but you help finance that and add a bit of protection by selling a short-dated, slightly out-of-the-money put option. And critically, you time that put option to expire after the fall turnaround season is likely done and dusted.
Okay, let's break down the rationale. Rationale 1, you're playing the explicit guidance to beat last year's EBITDA, plus you have that strong visibility into the fall O&G work already in the backlog. That should de-risk the second half considerably, right? It's a near-term catalyst.
Exactly. Rationale 2. The premium you get from selling that put acts like a cushion. It hedges against that main near-term risk. What if the ERP system normalization takes longer? What if cash flow stays messy for another quarter? Selling the put gives you some downside protection against those operational hiccups, while you still keep all the upside potential from the margin expansion story if things go right.
So the core bet is really on execution. Your betting management delivers on that sub 2.5x leverage target by year end. If they do, it proves the new model works, the structure is sound, and that should trigger a re-rating, closing that valuation gap.
Precisely. It's a wager that management can navigate this short-term operational complexity to achieve that long-term structural profit improvement.
A very specific bet tied right to those balance sheet targets. Okay, so wrapping up this deep dive for you. Q2 2025 for Mistras Group was clearly a rip-the-band-aid-off quarter. Painful but necessary cleanup. They cut unprofitable business to boost margins while simultaneously pouring fuel on their tech assets like PCMS and aiming them squarely at hot growth areas like data centers and AI power needs.
And maybe one final thought for you, connecting this back. That midstream O&G business, their traditional core, it's struggled for like 6 quarters now with tough competition and pricing pressure. So the big question is, while they're bullish on this fall's turnaround work, will the new focus on things like data center power really be enough to fully revitalize that whole segment long term? Or does the structural change mean they might need to prune even more of that legacy O&G services business to truly maximize overall company profitability down the road? Something to think about.
A great question about the future shape of the company. Thanks for joining us for this deep dive on the Mistras Group earnings call. We hope this gives you the insights you need to continue your own research.